All right, let's get into it. This is your monthly reminder, and I want you to treat this seriously because what we are going to cover today affects you, your spouse, your parents, your neighbors, your coworkers, really anyone in your life who is dealing with Social Security, Medicare, or taxes right now. We are in February, and there are some very specific things you need to do, some things you need to avoid, and some decisions that could genuinely cost you or save you a significant amount of money depending on whether you know about them. I have got about 8 to 10 things to walk you through today, and I want to make sure every single one of them lands clearly. So let's not waste any time. The number one thing I want to address right out of the gate, and I am going to ask you to please share this with everyone you know because there is a lot of confusion out there right now, is the question of taxes on Social Security. You have probably heard it. A lot of people have heard it. The idea going around, and honestly, it has come from some very high-profile voices, including the President of the United States, is that Social Security benefits are no longer taxed. And I have to be straight with you because that is what this channel is about. That is not accurate. Not right now. Social Security benefits can absolutely still be taxable depending on your income. And a lot of people are going to get a very unpleasant surprise when they file their taxes if they have been operating under the assumption that they owe nothing. Here is how this actually works, and please pay close attention to these numbers because they matter. The IRS uses something called combined income to determine whether your Social Security benefits are subject to tax. Combined income is your adjusted gross income, which you will find on line 11 of your tax return, plus any non-taxable interest you received, plus half of your Social Security benefits. That last part is where a lot of people get tripped up. The IRS only counts half of your Social Security benefit in this calculation, not the full amount. So if you are single and your combined income comes out to under $25,000, you are in the clear. Your Social Security benefits are not taxed, but if your combined income is between $25,000 and $34,000, then up to 50% of your benefits may be taxable. And if it goes above $34,000, up to 85% of your benefits could be subject to federal income tax. For married couples filing jointly, those thresholds are higher, but the same structure applies. Now, there was something added through recent legislation, sometimes called the Big Beautiful Bill, that does provide a deduction. If you are single and your income was around $100,000, you can deduct $6,000, so the IRS effectively treats your income as $94,000. If you are married, that deduction is $12,000. That is real relief, and it helps a lot of people. But it does not eliminate the tax on Social Security entirely, and that is the critical distinction. A lot of people heard about the deduction, heard the president talk about removing taxes on Social Security, and mentally combined those two things into something that is not quite reality yet. So please, before you file, before you tell your neighbor or your brother-in-law that their Social Security is tax-free this year, make sure you actually run the numbers. The IRS has a free 9-minute quiz on their website that will walk you through whether you owe taxes on your benefits. It is simple, it is straightforward, and it will give you a real answer based on your actual situation. Now let's move into something that I dealt with constantly when I worked at Social Security, and it is especially relevant right now because this is the time of year when a lot of people are either retiring or seriously thinking about it. February is one of the busiest periods for retirement applications, and there is one misconception that stops people from starting their benefits when they actually could and should. Here it is. A lot of people who are planning to retire mid-year look at their total projected annual earnings and say, well, I am going to make way over the annual earnings limit this year, so I guess I cannot start collecting Social Security yet. And they wait. Sometimes they wait an entire year unnecessarily. That is money left on the table, and it does not have to happen. Here is what Social Security actually cares about in your first year of benefits. They do not look at your total annual earnings for the year you start. They look at your monthly earnings going forward from the month you begin receiving benefits. So let's say you are planning to stop working in July. Maybe you made a significant income between January and June, well above the annual earnings limit. Social Security essentially sets that aside. What they want to know is how much you are going to earn each month starting in July. If you are going to be under the monthly earnings limit going forward, which is currently $2,400 per month, then you can start your benefits in July. It is that straightforward, and it genuinely surprises people every single time I explain it. The annual earnings limit becomes relevant in your second year and beyond. But that first year, Social Security operates on a monthly basis. So if you or someone you love is sitting on the sidelines waiting for next year because of what they earned in the first half of this year, please pass this along. They may be able to start their benefits much sooner than they think. Now, I want to shift to something that has nothing to do with Social Security directly, but could genuinely be one of the most important pieces of practical information you hear this year. It is about hospitals, and it is about protecting yourself and your family from financial devastation during a medical emergency. Here is the situation. If you or someone in your family has a medical emergency, the hospital you end up at can make an enormous financial difference. Under the Affordable Care Act, nonprofit hospitals, meaning hospitals that do not pay taxes, are required to provide charity care. That means if you receive emergency treatment at a nonprofit hospital and you cannot afford to pay, that care can be provided at no cost to you. It is called charity care, and it is a legal requirement for nonprofits in exchange for their tax-exempt status. For-profit hospitals have no such obligation. They will bill you, pursue you, and if you cannot pay, you may end up facing medical bankruptcy. So here's the homework I want you and your family to do this month. Make a list. Right now, before anything happens, look up the 2 or 3 nearest hospitals to your home. Go to their websites. They are required to display their nonprofit status prominently and identify which ones are nonprofit. Then make sure the people closest to you know that if something happens, and there is a choice, take you to the nonprofit first, put it on your refrigerator, put it in your phone. This is the kind of simple preparation that most families never do and deeply regret not having done. Let's talk about your earnings record, because this time of year, while you are already thinking about taxes and finances, is the perfect time to do this. Your Social Security benefit amount for the rest of your life is calculated based on your earnings record, meaning the wages you paid into Social Security over your working years. If your earnings record is wrong, your benefit will be wrong, and you will not necessarily know it unless you check. Setting up a My Social Security account at ssa.gov takes maybe 15 minutes, and it gives you full access to your earnings history. Go in there and look at it. Make sure last year's earnings are recorded correctly. Make sure the years going back look right. If you see something that does not match what you actually earned, contact Social Security and get it corrected. The sooner you catch an error, the easier it is to fix. There is also something worth watching for that most people never think about, which is whether someone else has been working under your Social Security number. I know that sounds alarming, but it does happen. Someone in another part of the country might be using your number, paying into the system, and technically boosting your earnings record. Your first instinct might be to think that sounds fine. Extra contributions never hurt. But when Social Security catches it, and they almost always do, those earnings get removed from your record. If you were already receiving benefits based on an inflated earnings history that included someone else's work, you will likely face an overpayment and be required to pay it back. That is a nightmare you want to avoid entirely. So look at your record, and if you see any employers or income that you do not recognize, call Social Security and flag it right away. Get ahead of it before it becomes a problem. I also need to address something that is genuinely out of control right now, and it is the wave of fake AI-generated videos spreading misinformation about Social Security. These videos are using the faces and voices of well-known financial figures like Dave Ramsey and Warren Buffett, people who have nothing to do with these videos, to tell people things like their Social Security checks are going to stop unless they take some immediate action. It is completely fabricated. It is designed to frighten people into clicking, calling a number, or handing over personal information. If you see one of these videos, please do not engage with it, and please warn the people around you, especially older family members who might be more vulnerable to this kind of manipulation. You do not need to do anything special to keep your Social Security benefits coming. The legitimate information will come directly from Social Security through official mail, not through a YouTube video featuring a celebrity you recognize. Now, we need to talk about Medicare because we are currently in the Medicare Advantage open enrollment period, which runs from January through the end of March. This is your one opportunity during this window to switch your Medicare Advantage plan if it is not working for you. A lot of people signed up for a plan in the fall during the annual enrollment period, and now that they are actually trying to use it, they are discovering that a doctor they need is not in the network, or a medication they take is not covered the way they expected, or they have moved and their plan does not work in their new area. If any of that sounds familiar, you can change your plan right now, one time, and your new coverage will start the following month. When you are evaluating your Medicare Advantage plan or looking at alternatives, there are 7 things you want to keep in front of you. Your current plan details, the providers you want to keep seeing, your prescriptions and how they are covered, which pharmacy you use, your health priorities for the coming year, the actual costs, including premiums and out-of-pocket expenses, and finally, a persistent and patient willingness to fight for what you are entitled to. That last one matters more than people realize. These insurance companies are businesses, and they will find ways to make things complicated. Prior authorizations get denied, claims get rejected, coverage gets disputed. You have to push back. You have to appeal. You have to be persistent because a lot of people who are fully entitled to coverage end up losing it simply because navigating the process wore them down. The same persistence applies to Medicaid. This is something I want to address head on because what is happening with Medicaid right now across the country is genuinely difficult for a lot of people. States have lost significant federal Medicaid funding, and they are actively removing people from Medicaid rolls, sometimes people who are completely eligible. The process they use is not always straightforward. They will send you paperwork on a tight deadline. They will make it hard to reach someone by phone. They will require documentation that takes time to gather. And if you miss a step or a deadline, they will drop your coverage even if you did nothing wrong. I have been hearing this from people in state after state. You call to schedule an appointment and nobody answers. You cannot get into an office without an appointment. The deadline passes and suddenly you are without coverage you legally qualify for. If this is happening to you or someone you know, do not give up. You have appeal rights. Document everything. Keep calling. Keep pushing. Losing Medicaid coverage when you are eligible is not a final answer. It is a bureaucratic obstacle, and it can be challenged. Now, let's talk about overpayments, because February through April is when a lot of Social Security recipients start receiving overpayment notices, particularly those who worked last year while receiving benefits. If you earned over the annual earnings limit last year, Social Security will eventually calculate what they should have withheld and notify you of what you owe. It is not a penalty. It is just the system reconciling the annual earnings limit after the fact. But it does catch people by surprise when the notice arrives. Related to this, there is a really common question about what happens to benefits that were withheld because of the earnings limit and when and how you get that money back. The short answer is that you do get it back, but not as a lump sum. Here is how it works. When Social Security withholds monthly benefits because you earned too much before reaching your full retirement age, they keep track of how many months of benefits were held back. Once you hit your full retirement age, Social Security recalculates your benefit amount and essentially credits you for those withheld months by permanently increasing your monthly payment. So if they withheld 5 months of benefits, your monthly benefit going forward gets a permanent bump to reflect those 5 months being added back in. It is automatic. You do not have to file anything or call anyone to trigger it. It just happens when you reach full retirement age. One more thing worth knowing about. If you started your Social Security benefits and within the last 12 months you have decided it was a mistake, maybe you found a great job, maybe your financial situation changed, you actually have an option called a withdrawal of application. You can contact Social Security, tell them you want to withdraw your application, and they will send you a bill for the benefits you have already received. Once you pay that back in full, it is as if you never filed. Your record resets completely, and you can refile later with no penalty and no reduction based on the earlier filing. It is not the most commonly known option, but it is real, and it has helped a lot of people who started benefits before they were truly ready The bottom line for February is this: check whether your Social Security is actually going to be taxed this year before you assume it will not be. If you are planning to retire mid-year, look at the monthly earnings rule before you decide to wait an entire extra year. Know which hospital your family should take you to in an emergency. Check your earnings record at Social Security. Stay sharp about the Medicare open enrollment window closing at the end of March. Fight back if Medicaid tries to drop you. Prepare for possible overpayment notices if you worked last year. And please ignore the fake AI videos trying to scare you. None of them are real. All of them are dangerous. Share this video with anyone you think needs to hear it, because the people who get caught off guard by this stuff are almost always the people nobody took 10 minutes to warn.